Alright, so here we have an example of that accretion stuff. So this mining company pays $50 million for the right to explore and extract copper from the land owned by the state of Wyoming. To obtain the rights, they have agreed to restore the land to a suitable condition for other uses after its exploration and extraction activities. They incurred exploration and development costs on top of the uh, costs for the rights of an additional $15 million on the project. The company's credit-adjusted risk-free interest rate is 6%. It estimates the possible cash flows for restoring the land 3 years after the extraction activities begin as follows. So you have cash outflows and possibilities here. And so 5 million at 40% is 2 million, and 10 million times 60% is 6 million, so it's 8 million total. And you're going to determine the present value interest factor of $1. And so whatever that is, you multiply that times the $8 million, which is the 2 million plus the 6 million. And so the answer here comes out to be C, because you've got the following going on. You're adding the 8 million times the present value interest factor of 0.83962, which is the present value for an interest rate of 6% for a period of 3 years. So that calculation is 6,716,960. You add that to your cost of the mine, and so the total cost is 71,716,960. All right, so let's talk about intangible assets. So these represent exclusive rights that provide benefits to the owner. These intangible assets lack physical substance, and it's difficult to anticipate the timing and the existence of future benefits attributable to many of these intangible assets. Not all, but many. And so you have a couple of different ways you can acquire intangible assets. Certainly you can buy them from someone else who develops them, such as when you buy a patent from the patent holder, or you can develop these intangible assets internally, just do it yourself. On top of that, some intangible assets have a finite life, in which case you're going to amortize them, whereas some intangible assets have an infinite life. So you don't amortize those, you simply review each year and determine whether or not the useful life of the intangible asset has been impaired. And so the cost to capitalize, if you purchase it, is the purchase price plus any other cost to get the intangible assets to its intended use at its desired location. So the types of intangible assets you could have are patents, copyrights, trademarks, Franchises, a patent is a right to manufacture a product exclusively or use a process exclusively. The U.S. Patent Office, if granted, gives you uh, a life, well, it gives you exclusive rights for 20 years. The costs that you capitalize are the purchase price if you purchase it. Otherwise, it's the legal fees and filing fees if you generate the patent internally. Any R&D costs to develop this patent are expensed, not capitalized, so they're expensed in the period incurred. Copyrights are a right to protection given to a creator of a published work, such as a song, film, or book. It is being granted the exclusive right to use the product or use the, I said product, but I meant, whatever the work is, either a song, art of some sort, book. You get to have exclusive rights to it, and if you want to sell that off, that's fine, but you get to use it however you wish for your life plus 70 years. The costs that you capitalize, of course, if you purchase it, cost of purchase plus any legal fees, filing fees. If you develop this copyright in-house, then you're just going to have legal and filing fees. You're not going to be able to capitalize any R&D costs. Not sure what R&D costs you're going to have for copyright anyway, but if you have any, you're going to expense when incurred. Trademarks, that is a right to display a word, a slogan, a symbol, or an emblem, such as the Nike swoosh is a trademark. When you see that symbol, you know it means Nike. And so the right you get is essentially infinite, because you get to register that slogan, symbol, or emblem or word for a period of 10 years, and it can be renewed for an additional 10 years every 10 years. So it's essentially limitless as far as how long you can have this. Again, the costs that you capitalize are the purchase price if purchased, otherwise just the legal and filing fees, and again, R&D incurred internally are expensed. Franchise rights are exclusive rights by a franchisor to the franchisee to use the franchisor's trademark or product. The franchisor grants it for a specific period of time to the franchisee, and so the franchisee capitalizes the initial payment plus any periodic payments over the life of the franchise agreement. Goodwill. It represents the unique value of a company as a whole over and above its identifiable, tangible, and intangible assets. Now, this goodwill can emerge from several different areas, any or all. It can arise from clientele and reputation, trained employees and management team, or just favorable business location. So, bottom line is any internally generated goodwill does not get capitalized. The only time goodwill gets capitalized is when one company acquires uh, the assets of another company and the consideration paid is more than the fair value of the net assets. And so essentially you're buying more than just the net assets. You're buying these other things, clientele and reputation, etc. Because goodwill can't be separated from a company, it's not possible for a buyer to acquire it without also acquiring the whole company or a portion of it. And so what you do is you look at the fair value of the consideration exchanged, aka the acquisition price, and you compare it with the fair value of the net assets acquired, and if the fair value of the consideration exchanged is greater than the fair value of the net assets acquired, then that excess is called goodwill. So here we have a situation where the Smithson Corporation acquired all the outstanding common stock of Ryder in exchange for $180 million cash. Smithson assumed all of Ryder's long-term liabilities, which have a fair value of $120 million. The fair values of all identifiable assets of Ryder are as follows: receivables of $50 million, inventory of $70 million, property, plant, and equipment of $90 million, and a patent for $40 million. All right, so here you have fair values of the assets are 50 plus 70 plus 90 plus 40, so that's 250 million, less the liabilities assumed of 120 million. So the net assets, which is the total value of the assets less the liability assumed, is 130 million. They paid 180 million, so the goodwill is going to be the difference of 50 million. And here's how you would make your journal entry. Now this is in the journal of the acquirer, the acquiring company. All right, so we have an example here. Dearden Golf Ball Company acquired all the outstanding common stock of Sanderson Golf for $1,750,000. The book values and fair values of Sanderson's assets and liabilities on the date of purchase were as follows. So you've got fair value of these assets of $1,885,000 less the liabilities of $300,000. So whatever that is, $1,885,000 so $1,585,000. So $1,585,000. You subtract that from the $1,750,000. So you're going to have goodwill of $165,000. Lump sum purchases. So you're purchasing a bunch of assets for one price here. So how do you handle that? And usually it's going to be the second example. It says valuation of the assets differs when each asset is indistinguishable. So this is pretty easy example. 10 identical delivery trucks purchased for a lump sum price of $150,000. You're simply going to have each one valued at $15,000, right? More problematic is assets that have different characteristics and different useful lives, such as when you acquire a factory that includes various types of assets, such as land, building, and equipment. That's the more likely example. And so here you allocate the lump sum acquisition price among the separate items based upon their separate fair market values. So let's show you how that's done. Now here you've got this company that purchased an existing factory for a single sum of $2 million. The price included title to the land, factory building, and manufacturing equipment in the building, and a patent on a process the equipment uses, as well as inventory of raw materials. An independent appraisal estimated the fair value of the assets if they were purchased separately. So you've got land with a fair value of $330, building $550, equipment $660, patent $440, and inventory of $220. And so you're going to take, the process is you're going to take the fair value of each separate item and divide it into the total fair value of all items. So here land is $330 divided into $2,200,000, and so land is 15% of the total fair value of all assets. And so you're going to do that for each one of these, and so that what you're going to come up with is an allocation percentage for each asset, and you're going to take that allocation percentage and multiply it by the single sum of $2 million. And so, for instance, and when you look at this, they've got this totally wrong. This should be 330,000 over 2.2 million, not 300,000. So that is an error on the author's part. And so you simply take the 15% and multiply it times the 2 million single sum. And so, for instance, land is going to be allocated 300,000 of the total purchase price, and so on and so forth for each asset. So you see the allocation, the percentage of allocation for each one based upon the fair value divided of each asset divided into total fair value, and then you take that and multiply it for each asset times the purchase price of the total assets. And then you simply put them on your books with that journal entry. All right, so we have a situation here where Cirrus Corporation acquired a manufacturing facility on 5 acres of land, lump sum price of $32 million. The land includes land improvements such as landscaping, a sprinkler system, a parking lot. According to independent appraisals, fair values were $18 million, $12 million, and $10 million for the building, land, and land improvements, respectively. The initial values of the building, land, and land improvements would be what? So lump sum purchase price of $32 2 million. Independent appraisals for each item total 40 million. So you're going to take and you're going to divide 18 into 40, so whatever that is, for the building. So that's 45%, and you multiply that times. So building is 14,400,000. So you can tell from this that the rest of them are going to be land 99.6 million and land improvements of 8. So C is your answer. Let's talk about non-cash acquisitions. So this can come from 4 different situations. Deferred payments, such as notes payable, an issuance of equity securities, stock. You might have assets donated to you from an unrelated party, such as a municipality. Or you could have an exchange of non-monetary assets for other assets. So, assets acquired in a non-cash transaction are valued at the fair value of the assets given or the fair value of the assets received, whichever is more clearly evident. And so, deferred payments pretty easy, where you go out and you obtain assets in exchange for like a promissory note or note payable, if you will. So you get the asset, but you get it in exchange for an obligation to make payments in the future. So here you have an example of a machine acquired for $15,000, and you sign a note requiring payment of the $15,000 in the future plus interest at a realistic interest rate. You're simply going to debit machine and credit note payable. Well, what happens when you acquire something and you obtain a note, but the note doesn't have a specific or specified interest rate? Well, you have to imply an interest rate from the note, essentially. So we have an example of that here. Midwestern Steam Gas Corp purchased an industrial furnace. In payment, Midwestern signed a non-interest bearing note requiring $50,000 to be paid on December 31, 2019. If Midwestern had borrowed cash to buy the furnace, the bank would have required an interest rate of 10%. So the implied interest rate is 10%. So that has to be factored and separated from the fair value, the actual fair value of the asset. So what you have to do is figure the present value of the note by taking the $50,000 face value of the note and multiplying it by the discount rate. Here it's 10%. This is a 2-year note, and so you go to your present value tables, and N equals 2 and I equals 10%, so the present value factor is 0.82645. You multiply that times the amount of the note, and so the implied value of the furnace is the difference between the $50,000 note and the discount on the note. So here, the note payable was $50,000. The discount on the note is $50,000 times 0.82645. That's going to equal $41,323. So that's the implied value of the furnace, and then your other part of this debit is going to be to discount on note payable. And note what happens when you handle this. You're going to have, at the end of year 1, you're going to have an interest expense of $4,132 based upon the implied value of the asset times 10%. So essentially what you're doing is you're amortizing the discount. So debit interest expense $41.32 and credit discount on note payable. So essentially you're decreasing the discount on note payable by $41.32. Now on year 2, your amortization is going to be based upon the original $41,323 plus the $41,032 that you amortized in year 1. So $41,323 plus $41,332 is $45,455 times 10%. So you debit interest expense of here $4,545, and you're going to close out your discount on note payable account with $4,545. And then of course the other part of this transaction is paying the note payable face amount, $50,000, with $50,000 cash. Now, if you know the fair value of the asset, such as we have here, let's look at what we do. On June 2nd, 2018, Denison Inc. purchased a machine and signed a non-interest-bearing note in payment. The note requires the company to pay $100,000 on December 31, 2020. So what is that? 18, 19, 20? 3 years. Denison's not sure what interest rate approximately or appropriately reflects the time value of money. However, price lists indicate the machine would have been purchased for cash at a price of $79,383. So here you're simply going to note the cash price of the machine, $79,383. The difference between the note payable and the machine's cash price is your discount on note payable, and you're simply going to amortize that over 3 years. 3 years of the note. So the present value factor notice is 0.79383 divided into, well, the present value is the face amount times the present value factor. The present value factor here is 79383 divided into $100,000 equals 0.79383. Bottom line is present value factor, you look at, in this case it's 0.79383, and you look at your tables to figure out where that particular present value factors falls within the present value table, and it happens to lie in the interest rate of 8%. They really made that difficult. Now, I believe we talked about how you figure out the interest rate on these things last year, or last term, so just look at that and make sure you understand that you've got a present value factor of 79383. You know the number of periods involved here. Well, they say it's 2. Yeah. I don't think that's right. It appears to be 3. 18, 19, and 20 are 3 periods, but they say in 2 periods in this example. So anyway, bottom line is you go ahead and whatever the number of periods it is, you look in that table, and wherever you see the present value of 0.79383, that's your interest rate in that column. Alright, so anyway, Edgar Inc. on January 2nd of 2018 purchased a machine and signed a non-interest bearing note in payment. The note requires the company to pay $200,000 on December 31 of 2020. Edgar is not sure what interest rate appropriately reflects the time value of money. However, price lists indicate the machine would have purchased for cash at a price of $120,000. Okay. Edgar records the asset at what price on January 2nd? Well, obviously it's cash price. Issuance of equity securities, pretty easy. This occurs when small companies incorporate and the owner or owners contribute assets to the new corporation in exchange for ownership securities, stock. Transactions exchange value is either the fair value of the assets received by the corporation or the fair value of the shares of the corporation's stock if it is actively traded. And so, example here, on March 31, 2018, the Elkhorn Company issued 10,000 shares of its no-par common stock in exchange for land. On the date of the transaction, the fair value of the common stock evidenced by its market price was $20 per share. And so you're going to put this land on your books at the fair market value of the shares given, which is $200,000. So here's your entry. Donated asset. You'll see this where municipalities will entice donors or entice companies to do something, so they donate land or something like that, something very similar. And so here, the company receiving the donated asset records the asset at the fair values based upon either the available market price or an appraised value. As far as what's credited is they credit revenue. So they have to recognize revenue. So we have a situation here where this company decides to relocate its office headquarters to the city of Westmont. The city agreed to pay 20% of the $20 million cost of building the headquarters in order to entice Elkhorn to relocate. The building was completed on May 3rd, 2018. Elkhorn paid a portion of the cost of the building in cash. And so 20% of 20 million is your revenue. And so you're going to pay cash of 16. And so they put the building on the books at its cost plus what the city paid, 20% of 20 million. So here, this corporation acquired a patent from its founder, Jim Shackelford, in exchange for 50,000 shares of the company's no par value stock, no par common stock. On the date of the exchange, the common stock had a fair value of $22 per share. Determine the cost of the patent. So you're simply going to take the 50,000 shares and multiply them by the $22 per share. So that is 1,100,000. All right, so that's it for sections A and B. And next week we'll talk about section C in class.